I'm Jay Young. I'm co-founder at Real Property Associates and oversee our property management division. Thank you for joining. I think that we wanted to kind of bring this webinar to you simply because we are in an insurance industry that, as you know, is just ever changing. It feels like as a property owner, 5 or 10 years ago, you would place your insurance policy on your building. You would forget about it every year. It would renew automatically, maybe go up a little bit, and it was just kind of out of sight, out of mind. Within the last couple of years or 5 years, that has changed dramatically. Insurance companies are leaving the market. They're changing kind of the rules by how they want to underwrite the property, and it's just been a really big concern within our industry and for landlords. So we wanted to kind of provide this as being a forum where if you are a landlord or you're managing property for a landlord, that you can get the best information you can about kind of where the market's headed. So I have invited Dave Taylor, who is a owner of FirstMark Insurance Company, to come on the webinar. He brought 3 of his brokers with him, so he's got a lot of knowledge, and we're just going to kind of spend the next 20 minutes or so talking about number one, what's happened to the real estate world, and is this the new normal? And then if so, kind of how we can kind of navigate. And we've got a bunch of questions that have already been submitted, so we're hopefully going to get through that. So thank you for coming on. If you got any questions, put them in the chat and we'll try to get through it. Dave, can you introduce yourself and your team?
Yeah, absolutely. Thank you, Jay. Excited to be here today. And I know we've got a lot to get through in a short amount of time, so I'll talk very quickly. Just as a point of background, FirstMark Insurance Group, we're based here in the Puget Sound area. We're a large independent brokerage. We're licensed in over 30 states. We have over 60 million in premium that we manage. So I tell you that just so you know that we have a lot of experienced folks on our team. We deal with these questions all day, every day. So my hope today is that we'll be able to provide you guys some answers to the questions that you have, because I do know, as Jay said, the market seems to be in flux and a lot going on. And so we just want to be able to hopefully give you guys some comfort about where things are at, where they're going, and answer your questions. And so to do that, I've brought along 3 awesome folks with me today. We got a couple that specialize in personal lines insurance. So that would be for any of you that have rentals that are 4 units and less, 4 doors or less. That goes on a personal lines policy. 5 doors and more goes on a commercial policy. So on the personal lines side of the house, I've got John Applegate with us. John, his nickname at the company is the Professor. This guy knows everything about everything, and he has worked in the industry a long time, I think longer than me. So that's why I bring him along too. So John will be here speaking on personal lines along with Matt Smith. Matt is another one of our agents that's been doing this a long time. He actually is the trainer at our agency for all of our new agents on product, and so another wealth of information. And then if we look at the commercial side of things, which is uniquely different, right? So there's a reason we have 2 different departments. We have personal lines and commercial, because commercial is uniquely different in many ways. We have Marie Loran, who is with us, who is our commercial new business manager. So to keep things moving forward, I've asked Jay if he could keep me out of this and he could moderate, and he's just going to pose the questions to these guys. So just when you hear these answers, just again, a reminder, when you hear from John and Matt, you're going to be hearing about the personal line side, 4 doors and less. You hear from Marie, you're going to be hearing about the commercial line side, which is 5 doors and more. Okay. All right, back to you, Jay.
Okay, and so who wants to take on the first question? Is this the new normal? Are things going to kind of go back to where they were, or is it going to be something where, every year we're kind of fighting for, getting our buildings reinsured, rates kind of going through the roof? I mean, what's that looking like for the next couple of years? Do we know?
Yeah, let's tackle that. Let's always just go format. John and Matt, you guys go first on personal lines, and we'll have Marie answer if she has anything additional, different to add.
Okay, I can take that. Yeah, I think obviously insurance rates have been pretty bananas the last 2 to 3 years. Last 2 years in particular, I think. And I've been seeing rates, I don't want to say going down too much, but definitely stabilizing a smidge, especially in the second half of this year. And this is just from the personal line side. I think that's a kind of across the board. Homeowners, personal homeowners, auto insurance, and the dwelling fires, which are the landlord policies. Starting to see a bit of a leveling out. Can't say I've seen too much of a price drop, maybe a little bit, but more leveling out than anything. So that's good.
Commercial line?
I would agree with that on the commercial side as well. We're seeing some stabilization, but it's like we don't have a crystal ball, right? But right now things are not continuing to go up in rate. They're kind of staying moderately about the same.
It feels like the age of the building is a big differentiator. Is it 25 years and over and just nobody wants anything to do with it in the newer build, or is that not true?
That's pretty common on the commercial side. There's a couple carriers though that are entertaining older buildings and doing some things that are a little bit unique that are newer in the marketplace.
From the personal side, anything post 1920 is usually pretty fine. We can always find solutions for older ones, no problem. Some ancillary type of coverages aren't available on the older ones, but we have ways to kind of inflate coverages to prevent a shortcoming. But updates to systems, roofs, always a huge one. All of those things, even if they were built in 1910, 1900, if those things have been fully renovated, you're usually okay. You still have a lot of options available.
Yeah, and it feels like in years prior, you'd be able to answer a questionnaire like, has your plumbing been updated? How's your electrical been updated? Has your roof been updated? And we could all just say yes, yes, yes. And now, we answer those questions and they actually are sending out inspectors and they're saying, okay, prove it. Show me that your wiring is really updated or that your plumbing is copper or that your roof's been updated. And so it feels like they're really drilling down on that. And then come renewal time, they're giving you a big list of stuff to say, okay, we want, we want the gutters fixed or the bushes trimmed back and, really getting after the condition of your building.
Say that feeling is insanely accurate. That is very, very true on all fronts. Yes.
Yeah. So part of what we can do as owners and managers is just to kind of get out in front of that and make sure that, okay, if you do have, Zinsco panels or you do have, some stuff that we know are known defects, let's go ahead and get bids. Let's get that stuff done prior to your renewal so that, it's not going to be an issue.
Yeah, 100%. And trees, overhanging trees, big deal.
Yes.
Yeah, I was going to say, it's like if we can, we have markets, if you have a property that has those things in it and we are insuring it at a higher level because of them, we still can have a strategy in place and a plan that gets those things changed. And once they're done, then we can remarket it back to the preferred side. So yeah, so it's not like once you start somewhere in a high rate one, you're stuck there. If there's things we can identify that can be taken care of, then we can switch you.
Okay, another kind of popular question was, what kind of risks are we faced as a landlord? So if I own a building, and I want to go to sleep at night, kind of what are the things that are going to keep me up at night? Is it, so who wants to address that? Is it coverage limits? Is it just the kind of policies? Can we talk generally about just unique risks?
Yeah, I'll continue on that one. Really, I think the biggest risk that landlords have is the fact that those properties are available in a lawsuit, right? I'm no lawyer and don't speak from that level at all, but my understanding is that they can't make you sell your primary home, right, in a lawsuit if you do something that winds up being that way. But investment properties can definitely be up for grabs. So to me, that's really the biggest thing is losing the whole thing, right?
Yep.
And the
So
best
number one is to quit claim your property into an LLC. That would be okay.
100%. Yeah, absolutely. And LLC trust stuff from an insurance standpoint, but protecting that outside of the LLC, umbrella policies. Having an umbrella policy that's going to help pay out for any judgment that goes against you, so you're not wind up having to push out and sell some of these properties. that would be like the number one thing that I would say is making sure you have an umbrella and making sure that you have enough coverage on that umbrella, right? They start at $1 million, can go up to 50 million plus, just kind of depending on what you need.
And that piggybacks on your initial policy, and it only goes into effect. And so it's generally pretty inexpensive to get an umbrella policy up to $1.5 million or $2 million, right?
Correct. Yeah, they're not super duper expensive. I mean, they can, it depends on the carrier, obviously, that you go with too, because some carriers have a flat rate no matter how many exposures you have. But I would say more often than not, each exposure you have, so each rental property you have, each car you have, each whatever is going to be another 30, 40, 50, 60 bucks. So it can start getting up there. But again, that's also where we, as advisors, try to help look at things holistically from the whole point of view of everything that you have and that needs to be insured. And so then we can make sure you're with the proper company that's going to give you the type of an umbrella that you need.
Okay. Okay, any other risks?
I think that's the biggest one, personally.
Yeah.
I mean, any sort of liability thing, right? And again, we'll talk about some other things, the importance of renter's insurance and all that, but which will help alleviate some of the risk. But to me, that's the number one risk, is just losing the lawsuit.
I would say your question was what to prevent from going to sleep at night, right? We talk about there's catastrophic losses and there's inconvenient losses, right? Catastrophic loss kind of is going to make it a bad year, like that really ruined my year financially. The loss Matt's talking about right now, whether it's personal lines or commercial, where it's a large liability loss at 7 figures or more. That's more than just inconvenient. Those are the ones that I would say probably keep people awake at night, or should. Didn't to what coverages. I think a lot of coverages, and maybe we can go into that. What are the important coverages to make sure you have on a policy? I think is a good question for both the personal lines and commercial. But I think the main one that you need to make sure you have plenty of so you can sleep at night is liability protection.
Okay. And then it also felt like, especially with the commercial lines, that there used to be more common was guaranteed replacement value, where you knew that if your property burned down, that it would be replaced no matter how much it cost. It feels like the industry is getting away from that, and now they're capping it, or they're putting an actual replacement value, correct? So
Correct.
how do I know that the actual is actually going to cover, the what it's going to cost to rebuild, or should not that be a worry?
I can talk about that part. So a long time ago, they used to give guaranteed replacement costs, but what happened was a lot of agents were undervaluing properties so that they could just use that guaranteed replacement as a Band-Aid to cover everything, right? And the insurance carriers kind of got smart and said, we're not going to keep doing that because we're showing up at a house that's 4,000 square feet and it was insured for 100,000, right? So what they've done is they've gone to having an extended replacement cap, as you said, usually at about 50% maximum. But on these rental properties, a lot of companies don't offer it at all, but most of them will offer a 25% extending, and that's usually the ceiling on the extending. So we have to just be super careful that we get it right when we do the valuation on the property, and know all the details about the home so that we can get that part right, and then use that extending to cover things like if there's a Hurricane Katrina or earthquake in Los Angeles, and now the price of labor and material just skyrocketed or just bumped up a lot. So we get the coverage on the dwelling property right, and then we use that extending to provide a buffer for that. Okay. And then each year we should do a review and make sure that there hasn't been any additions and things that would have altered that.
Yeah, Jay, where you get into trouble is someone that bought their policy 10 years ago. Their agent's not looking at it on an annual basis for them. That's just sat there. The carrier hasn't increased that, what we call coverage A or dwelling limit. And just understanding of what John's saying there. So if you insure your home for $1 million with 25% extended replacement costs, that means the most they'll go to is 1.25 million. versus what they used to do. They used to go unlimited in the past. So yeah, it's really important to make sure that that is not sat there on a shelf for 10 years and no one's looked at it. It needs to be reviewed on a regular basis to make sure you have it, because 25% is not a lot.
Okay. One of the other questions that came in was just what can we do to minimize insurance costs? So, certainly shopping around for the best carrier is a good one, but what, I think deductibles come to mind. Is it, it feels like it's almost better nowadays to kind of push the deductible up, get a little bit lower premium, and just not turn in claims, right? Because it feels like it's very damaging to turn a claim, and with loss runs and everything, it's like, oh, if I'm going to turn in a claim for $25,000, they're either going to cancel me or they're going to get it back somehow. So kind of what's the strategy for a deductible and actually turning a claim in?
Yeah, I can take that one. Deductible really is the biggest thing that you can do to help alleviate some of the premium increases that we've been seeing. Yeah, and historically, I'd say a lot of people have $1,000 deductibles, maybe $2,500, but getting into the $500, $7,500, even $10,000, and it's from the personal line side. Sometimes it makes sense. You just have to look at the savings overall. Some companies give you a pretty hefty discount for going up. Other ones, it's not so much. Between maybe say $2,500 to $5,000 is not much, but $2,500 to $7,500 is quite a bit, right?
Yeah.
So yeah, we kind of look at those things and try to keep in mind, like to your point, if you do make those claims, 100% be ready for a rate increase, right? Yeah. And the thing that can happen too, especially if you have multiple rental properties, a lot of these companies will, if you've got a claim at one place, you're going to get hit on all of your policies for that claim. So if let's say you didn't make a claim on that one policy and that rate's going to go up $1,000, well, it might go up $1,000 on all of your policies, right? So then that's something that you got to keep in mind when you're making those. And so when I talk to people about shouldn't I make a claim, I always say minimally, you're going to have $1,000 rate increase for 5 years, bare bones minimally. And so the claim should not even be considered until you're $5,000 over your deductible. And then from there, you talk about all these other things, having multiple properties and how those deductibles are going to go for each potential, or the rates. I mean, you really want to make sure you're getting the biggest bang for your buck.
And what's that look like for commercial then? How high can you go on a deductible? Can you go higher than 10,000 on a deductible?
On commercial, you can,
Mhm.
but what we're seeing on the commercial side, as far as like deductible swings, to go from, let's say, like a $2,500 deductible to a $25,000 deductible, the premium savings is small. So
Is
the
it?
carriers are not offering as big of a efficiency to take on more of the risk. But you can, and some carriers are even capping how high they'll go on a deductible. You used to be able to say, well, I want a $100,000 deductible. I'm not going to turn in anything under 100 grand. And some carriers are coming back and saying, that's great, but we're only going to go as high as 25. Where we're seeing the biggest kind of impact to save on rates on the commercial side is really in maintenance and housekeeping and updates. So, making sure you guys have proper procedures in place to replace water tanks and dryer vent cleaning regularly scheduled. The exterior of the building's well kept and maintained. You guys have updated, no subpar electrical panels, that kind of stuff. That's where we're seeing underwriters to be more acceptable to apply more credits and get the premium down on the commercial side here lately.
Okay.
Yeah, Jay, this is I've been doing this like almost 40 years, right? And this is like my least favorite conversation with a client is when they call and say have a claim, and we have to say, hey,
Yeah.
I really don't think you should turn it in, right? Because I mean, everybody like, well, it's insurance. What do you mean? I pay you all this money. I want to turn in my claim. I get it, right? That's a horrible conversation to have. But we position ourselves as the guide. We're not going to tell you what you want to hear. We're going to tell you what we know, right? And my concern with that, and I've seen it play out recently here multiple times, is always, yes, you could turn in this claim, and maybe it's a $10,000 claim, right? And that feels right. You could turn this claim in, but you don't live in a bubble where that's the only thing that's going to happen on that policy. If you turn in that claim and then nothing happens for the next 10 years, then it's somewhat going to be predictable about what's going to happen to that policy. But what if you turn in that claim and then 6 months from now, you have a $50,000 claim? Okay. Insurance companies look at frequency. Yeah, they look at severity, like how big is this claim, but more important, they look at frequency. Have we had multiple claims on this policy? And if they see multiple claims to them, that's an indication of a trend that they don't like, right? So that's just, there's a lot to consider. And those are conversations, like I said, they're not fun, but it's complicated. It's not a simple black and white. If you have this happen, this is what's going to happen to you. So we're just always trying to protect our clients, because I think the worst thing that happens is you turn in claims and get non-renewed by your carrier. That is absolutely the worst thing that can happen, because once you're non-renewed, now nobody wants you because you've been non-renewed. So now we're going into the surplus lines market. You're paying 4 times the premium for less coverage, right? So anyhow, so that's just, there's a lot to it.
And the process for shopping with a new carrier is everybody wants a loss run for the last 3 years, right? So they want you to pull the last 5 years losses, and is that just, does that have to be clean, or will they allow one? I mean, or is it, like you said, is it frequency? What's gonna, if I have 3 claims in 5 years, am I untouchable at that point, or is there any rule of thumb there for that loss run?
I think it's a very different answer between commercial and personal lines on that one. So let's let personal lines, you guys go first. What do you do in that situation? What do you see?
I would say 2 to 3 claims in a 2 to 3 year window, it's going to get you in trouble. The longer you've been with the company, the more the underwriter can look back at the history and say, it's been a very profitable customer. They just had a couple bad incidences. We're going to give them a chance. But if you just moved to a new company and then you had some stuff happen, you're probably going to get cut. And when you go to that high risk, they're going to raise the deductible really high, and you're going to get less coverage and pay way more for it.
Okay.
I was going to point out on the deductible side too, that if you have one home that you've got one rental home, you're going to save a minimal amount on the deductible change. But if you have 10 homes, that starts to really stack up. So the more homes you have, when you make that deductible change across the board, that can really add up and definitely be in the owner's favor.
Marie, on commercial, you want to answer that?
Yeah. So the older the claim is, the less kind of impact it has on ratings. So the newer, more fresh claims, I would say within the 3 year window, are the ones that are going to be of the highest concern. It will push us to the surplus market where costs are higher and coverage is more restricted, right? You don't get as robust of coverage. So for us on the commercial side, the most important part is being able to explain what exactly happened on that claim. What did you do to prevent it from happening in the future? So that we can kind of relay that information to help. But
we had a question. So there's a lot of carriers that are leaving the Washington market. We've seen that. Are there any new ones that are coming in either commercial or personal?
Let's go with Marie on that. I think that's personal lines. I don't think we've seen anything new per se.
So commercial.
So, yeah.
The newest carrier to kind of enter the Washington market is a carrier called Honeycomb. They're pretty unique as far as what they can offer, because they have an admitted paper where pricing is better, and then they can also, based on characteristics and loss history, can write on a non-admitted paper, which just costs more with taxes and fees. But they're fairly new into Washington as of end of November last year. So, and then overall as a company, they've been around about 6 years, mostly riding on the East Coast side. But they're the only new carrier to Washington.
And they are specifically for this conversation, they are a habitational writer of business. And our industry is very much a copycat, like the NFL, right? It is copycat. So like if somebody sees a carrier say, hey, we are not writing habitational, we're getting off it, everybody else goes, crap, they must know something we don't know, and they're jumping off it as well, right? So we've troughed on that, and I think we're starting to see a comeback with companies like Honeycomb that are willing to go back in there, because there are good habitational risks that are older. They're good, right? They don't deserve to be just discarded. So I think we're going to see, as they have success, I think we'll see additional carriers come into the market, hopefully in the near future.
We talked about older buildings being more difficult to insure. Are there any other types of products that are hard to insure? Other lines that you're seeing that maybe as an investor I want to stay away from it? Is it mini storage, or I mean, are there any different categories that are just having a really hard time right now?
Marie?
I mean, like, I think that one's kind of tough. I don't
Okay.
think so. I think they're
Okay.
all equal. I think some new solutions have emerged in the market. Even older buildings are becoming less of an issue, less of a problem, especially if they've been updated and well maintained, right?
Okay.
So
Yeah, I think in habitational, it's really age, Jay. If it's older than 25 years, we enter into a different discussion than if it's newer. For commercial real estate, I don't know if any of you, the folks on the call, have commercial real estate. When we get to commercial real estate, it's about your occupants. There's certain occupants that the insurance companies don't want to see. But yeah, for commercial, it's really about age when it comes to habitational. That's far and away the most important factor.
I know that one of the biggest things that we've really been pushing and is helped our owners is just the enforcement of renters insurance. So, you know, with all of our tenants, it's a requirement that they have renters insurance, and then they show proof of renters insurance. And that's generally renters insurance policy is a policy that is $100,000 of landlord liability for 5 perils. So if a tenant screws up and they, you know, cause a kitchen fire or cause a water line to some kind of damage that they're requirement for, then that policy kicks in and it reimburses the landlord for up to $100,000. And we've seen that over the last 3 or 4 years. We've seen that happen, you know, maybe over 10 times where we've had that policy. And that will stay off of the landlord's policy, correct? If it's just up to 100,000 and doesn't even stick on their loss run, correct?
Correct.
Yeah.
Yeah,
So
that goes around the renter's policy for the insured. It would go to their loss report.
Okay. So that's just been a real big win for a lot of our landlords.
Yeah, it's a good one, and I always have been recommending to my clients who are landlords to go up from that 100,000 liability, because honestly, the difference between 100,000, usually you have 100, 300, and 500,000 options, and the difference between 100 and 500,000 from an annual premium perspective might be $10. And so I've really been encouraging a lot of my landlords to go to that 3 or even 500,000 for that extra coverage.
Okay. Annie, were there any other questions that have trickled in? Or is
Yes, there have been.
okay? You want to fire a couple off?
Let's do it. So, and then we had a couple more people trickle in. Just FYI, there's a little Q&A button down at the bottom. Click on it, submit a question. So Jason is asking, how can we get state insurance commission to stop rate increases? Does this just depend on our state's regulations? What's going on there?
Well, I'll tell you this much. If you can help figure out how to get the state insurance commissioner to do anything you want, I'm all ears. Like, we'd love to have that conversation. But yeah.
How is it regulated, Dave? Is it just is it up to them to say it can only go up a certain amount, or what's the triggers on that?
So what happens in Washington, right? There's a lot of states out there that are file and use, where you can just, as a company, file your rate with the commissioner and immediately start using it. Washington has to be approved. And so companies will file with the insurance commissioner saying, we want to take a 15% rate increase on this book of our business, on this policy, this account, these types of accounts. They have to submit justification for why, saying that this is why we're doing it. Here's our numbers that justify why we need this rate increase. And that process is anywhere from 6 months on the best case scenario to 18 months more normal for the commissioner's office to look at it and get back and forth and finally approve it. And most times, whatever is filed for is usually cut in half. So it's turned into a game, right? It's turned into a game where if you really want 8%, you're filing for 20, right? And hoping you get your 8, whatever. So it's just, and then it also creates a problem too, where if a company needs to take 8% today, by the time they get it 18 months from now, not only do they need that 8%, they need an additional 4%. So anyhow, that whole DOI conversation, great question, whoever asked that. I mean, you know, spot on. If we could figure out a way to clean up that process, it would sure help everybody, consumer, carriers, everybody.
Awesome, thank you. So we also have a question from Keith. I think this is on a lot of people's minds, is earthquake. Keith says, I've had the same policy on a single family home that has been renewed yearly for many years. The earthquake premium has always been included. I recently went shopping around and other insurance companies were adding earthquake to a new policy at close to 50% increase. Is there a grandfather clause in regards to earthquake on existing policies? And if you lose it, if you make a change, how is handling earthquake handled? Or excuse me, how is adding earthquake handled now?
Let's let John speak to that. John is the king of earthquake at FirstMark, so we'll let it go.
Yeah, actually, most carriers no longer offer an earthquake as an endorsement. The two carriers that we use that are standalone companies are Palomar and Giovera. And they actually haven't had a rate increase in the 10 years I've been insured with them. And they aren't really seeing rate increases because we haven't had a major earthquake event along the West Coast. They insure in California, Oregon, and Washington. So that's a good thing. They do tend to go up a little bit because they give you more coverage every year because there's an inflation guard, so they bump up the coverage a bit. But the rates have been very, very stable if you go through those two carriers. When you're having an endorsement type of a earthquake plan where it's connected to the home policy, again, that's more rare these days, but then that can get affected by the home rates in general, right? Because they're taking hits and there's trees falling and there's, you know, broken pipes. And so when they take a hit, they pass that on to everything on that policy. But we definitely recommend earthquake. There's definitely a very, very high risk in this area. And when you do the math based upon the Northridge quake, that quake caused way, way more damage than many, many, many years of fires to residences here in Washington.
And what's John, what's generally the deductible on earthquake? Is it 50,000? Is it fairly high deductible,
Yeah.
correct?
The biggest mistake people make, in my opinion, is they go with a higher deductible. The deductible is a percentage. It's not a flat deductible like 1,000 or 5,000. It's the lowest we have is 2.5%, and the highest is 25%. We definitely want you to keep that deductible 5%, 10% or lower for sure. When you do the math, when you calculate how much more it is to go from maybe a 10% to a 5%, and you factor in the difference in the actual deductible amount that you would have to pay, again, because it's a percentage. So 10% of 500,000 is 50,000, right? So if you cut that in half by 5 to go to a 5%, now you're at $25,000 deductible. Well, when you do the math on the cost to go down on that deductible, to drive that deductible lower, it's taking you hundreds of years to get your money back. So the biggest mistake people make is they go with a high deductible, high percentage deductible to save money, but they're not really saving enough to take that next risk.
Thanks.
There's a question about grandfather as well. I would say that there's really no grandfathering in our industry. However, if you have a policy that has earthquake on it, you probably, until that carrier says we're non-renewing all of those, or until you cancel that policy, you'll be able to maintain it. But there's no grandfather to where as long as you keep it, you're guaranteed you'll always have it.
Thank you. We also have a question from Adi. For commercial real estate, are there types of tenants that insurers just don't like?
Marie?
There is. Yeah, I would say anything to do with marijuana, smoke shops, any high hazard like manufacturing.
Hookah lounge. They don't like hookah lounges. We know that.
They don't like hookah lounges, no. And then sometimes restaurants, right? If they don't have a proper sprinkler system, that kind of stuff. If there's living on top, so if they have apartments, second story, restaurants on first story, some carriers don't like that. And
there can be unique ones that we had a martial arts studio in one, and carriers didn't want anything to do with it. And this was a Class A building, awesome tenants other than a martial arts studio. And every preferred carrier said, nope. And I don't get why, but that's in their rule book. So there are unique ones, Jay. It's like if someone's looking at buying a building and if they want to get an opinion on, hey, are these occupants good? We don't know some of them unless we ask.
How are there's all these little trampoline companies that are opening up for kids that you go out and you take them out to the trampoline. How are those guys getting insurance? I'm sure that's just subject to lawsuit, right?
Oh, yeah. Yeah, I don't know.
Okay.
We don't insure any of those yet. But my guess is either they're grossly underinsured, they're
Yeah.
not insuring correctly, and they're just insuring with the old finger cross and hope nothing happens. So my grandkids aren't going there.
Okay.
So that looks like so far we haven't received any other questions.
Okay.
Though if anyone wants to throw anything in the chat or in that Q&A, we're still monitoring it.
Yeah, or we're good. I mean, we're at our timeline. So, I just want to say thank you to FirstMark and the group. In the webinar, you've got their contact information. They are certainly available to answer any questions or just take this information and, certainly run with it to your own broker if that you like. But you guys, thank you. This has been enlightening, and it's just kind of refreshing to kind of, all of the people that we've had a dislike for because they've been raising our rates. Now we get to see you, but we know it's really not you. So we're not going to shoot the messenger, right?
Thank you. We appreciate that.
You've been in a tough industry in the last few years, so we appreciate your hard work. Yeah, hopefully it mellows out, and hopefully we can be smarter about maintaining our buildings and our tenants and providing the best service. So thank you everyone for attending. Thank you, Annie, for organizing this. And guys, have a great day, and go Mariners. Okay.
That's right. Go in.
All right.
Thanks,
Thank
guys.
you.